Good afternoon, everyone. Sean
Yeah.
and Pete. Good afternoon, everyone. Sean and Pete here, EQ Private Wealth Advisors. Hope you're all doing well. It's been a little while. Certainly want to touch base. Have a lot to touch base upon, and let's get right into it. Markets are down, very down, really, really bad. It's been a pretty rough year. So we're going to get into that in a little bit in more details, and certainly some geopolitical issues to discuss, along with some inflation and the Fed, of course, happening this week as well. So plenty to unpack. So Sean, let's dive right in.
Thanks, Pete. I was like coming to work today and I was like, what a dismal year, right? And it's May 1st. We just started a brand new month. April was just a very big up and down type of month that we saw, right? And I go back and I say, wow, first of all, I can't believe we're in May 1. And since May, late last year, the market hit its all-time high, and we've just been playing this tug of war, right? But I think what I was thinking most about was I kind of wanted to go back and talk about, a little what happened about in 2020, right? And I think it has a lot to do with that, right? Of what we're experiencing today, right? And where we're going to be going in the next few more months, possibly a couple of years, right? So 2020, if everyone remembers, we started the whole year and everybody was like, oh, there's some chitter and chatter that's coming out with some virus. And, they were like, oh, this is only pertaining to Asia and China. Then it starts spreading out to different parts of the world. Next thing you know, by March of 2020, we're all in a lockdown for COVID. The pandemic we haven't seen for almost exactly 100 years, right? And if everyone remembers those times, we all remember a few things, our emotions that we had, right? We all were extremely fearful, but we saw what happened in the grocery stores. Everybody was like, running to get as much toilet paper they could possibly get and buy as much food because doomsday was coming, right? And I remember vividly, yes, like it was for me, like yesterday when the stock market was down 10, 12% on a daily basis, right? We saw about a 35% decline in the markets in just a matter of a month, right? It was extremely unprecedented times. Everybody was fearful. And then we saw something that we hadn't seen happen in this country for at least decades, where you got a combination of the Federal Reserve with its monetary policy and Congress with its fiscal policies come in and do a couple of things. Number one, what did they do? Congress came in, they started a whole PPP loans, the Paycheck Protection Paycheck Protection Plan, right? Program. Then they come out with the economic disaster loans, and they started sending a bunch of checks to all these, for everyone that was in the economy, right? And we started seeing all these different types of laws where moratoriums of making sure people aren't getting kicked out of their homes, and mortgages not being, if you didn't pay your mortgage, that was okay for a little bit. And a lot of different programs came in, right? And unemployment numbers are really ugly. We saw some social unrest, as you saw, right? I mean, things weren't all that good, right? Yet the stock market from June 2020 starts coming up, like incrementally coming up, not just like, and every time it was coming up, everybody was like, oh, this could be, a short-term thing that's happening. Oh, this might be short-term, but it just continuously went up. And it got to a point where we had a couple of really good years. I mean, that year in 2020, the market actually ended up being positive despite the pandemic. I think this is really important for people to remember, right? 2021 was a great year for the market, right? And now in 2021, we saw towards the end of last year, if you remember, people were getting the Omicron variant that came in, right? Businesses were going through different waves. Right now, we're going through another wave again. You see like 30%, I guess, COVID cases are up in California, Shanghai in China, and all these different cities in China are shut down, right? So, which is adding up to all the supply chain issues that we're having because those factories and workers aren't working. Therefore, we're still seeing shortages that are happening here. You put all this stuff together and you say, well, COVID has, we have a vaccine now, COVID has gone away. at least to some extent, or at least people are tired of, you know, um, being in lockdowns now at this point, right? But why is the market down? You know, and that's the that's the part that we're looking at. So in the beginning of the year, we started talking about Omicron. Shortly after, we started talking about the Ukraine and Russia invasion, which the horrendous humanitarian kind of crisis that are happening. And then now at this point, all eyes are on Fed and inflation, right? So there's a lot of news out there, and for the last 5 months, we've seen investors, especially in April. April was just a terrible month. Like, people are kind of starting to get a little bit more like, hey, I'm getting a little tired of seeing all these bad news come out.
Well, a lot of it was unforeseen, and then some of it was a little bit somewhat foreseen, arguably, right? Like you have, with the Fed, it's like you mentioned, it was propped up, the market was propped up by the Fed. So much money going in, affecting labor. And then you have also the geopolitical issues that was totally unforeseen. So now it's all eyes are on, the inflation, and a lot of talks about a recession as well. So brings us to, where do we go from here exactly? Well, consumers are strong, businesses are strong. Consumers, even though their savings rate has dropped, it's still historically high, around over 6%. Businesses' balance sheets are also very strong. In fact, speaking of businesses, I think we all saw earlier this week with the annual meeting for Berkshire Hathaway, Charlie Munger and Warren Buffett got together, and a good example of businesses being strong. They said, hey, you know what, we're gonna buy stocks, and we're gonna do buybacks. And buybacks are basically where a company feels like their stock is a little undervalued, and they've got some cash to invest in their own stock, so they buy back their own stock, seeing that there's a value there. So that's a pretty big deal, right? I mean, we haven't seen that in quite some time.
No, absolutely. I mean, what's interesting, you brought up Warren Buffett, and Warren Buffett is arguably known as the best investor our generation has seen, right? Unfortunately, we don't know how much longer we're going to be able to see this legend be in the marketplace a little bit. In fact, people are thinking that this might be his last annual meeting that he had. And in his annual meeting, they were actually talking about how they're going on to a little bit of a buying spree. Warren Buffett has a very famous saying, right? And he goes, when everyone's fearful, be greedy. And when everyone's being greedy, be fearful. And during the pandemic, he wasn't doing a whole lot in terms of purchasing and doing all these different acquisition plans that he has. But now he's got to a point where he's actually buying a lot of different company shares, right? So, and what? I mean, when you look at the markets, NASDAQ is down 20%, S&P is down about 13%, Dow Jones is down, 10+%, right? And what the other part of the equation is that a lot of people are not talking is the bond market and interest rates that have come up and what has done to it, right? So if you're in a diversified portfolio, and historically, if you're in a diversified portfolio and you own stocks and you own bonds are supposed to act in reverse historically with that trend. But now we see both bonds and stocks do terribly.
No, under attack on both sides.
On both sides, and that has created a little bit of a frustration for some investors at this point.
Sure. So, I mean, speaking of this point, right, we're 5 months in already. You blink your eyes, and here we are in May. And so, very fascinating stat that I wanted to share with you all today. Yes, it's been one of the worst starts to the year in the S&P's history, right? So we're down just about 14% from the peak in January. So one thing I want to share with you, here's the catch to that stat. Since 1980, the average year correction is 14%. Incredibly, 12 of the past 21 times since 1980, the S&P corrected at least double digits. It's managed to finish the year in the green. So I was kind of blown away when I read that. It just shows, how resilient the market could really be. And of course, there's always the argument, hey, this time is different. There's too much going on. This time is different. Why would this time be any different?
Like when you say corrections are normal parts of the market cycles, right? 10, 15% every 18 months that you're talking about that has happened. We just didn't see that for the past couple of years. And then a lot of people are kind of frustrated to see these kind of performances that happen, right?
Mhm.
But to your point, when you see a downturn like that and you say, oh, you know what, there was like a 14% correction, now the market is actually turned up, positive 14 months or, during the same year. Today is a great example of it, right? So we wake up, we see the market is down 100 points, 200 points, 300 points, 400 points. And just about 20, 30 minutes before closing, we see this incredible return back, and the market ends up being positive by half a percentage points, right? So, and unfortunately, this story has been kind of going on all year long, but especially since March 28th, it's been doing this a little bit more viciously, right?
Mhm.
And those vicious cycles are what scares a lot of people. And this is the part to be patient, right?
Mhm.
And practice
Mhm.
patience and equanimity as much as possible.
That's absolutely certain for sure. The one last thing I wanted to touch on was, fears of a recession. And here we are with the Fed meeting on Wednesday. Everyone anticipates a half a percentage point hike. Pretty significant, but I think you mentioned before in the past, we've chatted with a lot of you about it already, that yes, that is a pretty significant hike in rates. Half a percent is quite large, but also normal and in line with what really we should be seeing from the Fed.
Why I brought up the story from the beginning part of last couple of years was exactly for the same exact narrative that the Fed is using, right? So when things were so bad, they created stability in the markets, they brought liquidity into the markets,
Mhm.
and then they brought back sentiment, investor sentiment, right? So that people could, say, oh, I'm willing to take more risk. If you remember, everybody was going out buying Bitcoins and they were downloading some app, Robinhood, they were just like pressing buy by purchasing shares at that point. They were saying that there's a lot of new participants in the stock market, right? So there was a lot of free floating money that was out there. This money, they need to unravel this. And this might not be so bad for us, right? And yes, we're going to feel the short-term effects of it, but it's better than being in an inflationary period where everything's up. Like, back in the 1970s or 80s, when you would see interest rates north of 10, 15, 20%, just because like inflation was one of the biggest factors. So they're trying to do their part to be in front of it.
Mhm.
But when you got an inflation that we're right now, and a lot of that has to do with, of course, 40% of US dollars were printed in 2020.
Mhm.
You add that with, there's disruption in supply chain. What does that mean? It means that if your factory is not working and I need your goods, then I am going to go ahead and, the existing supply is going to, go up in price because the demand is in there,
Mhm.
because the price is going to go up, right? And that's going to affect prices. That's why we see used market prices up 35%. We've never seen that before, right? For a long time. And then you factor these with the war that's happening in Russia and Ukraine, where there's a lot of those two countries were big commodity providers. Obviously, there's a few double whammies that are happening simultaneously.
Mhm.
So all of these things being said, when the Fed come out and did what they did, and the Congress started, did all the fiscal stimulus packages that they did, so you saw a huge run into GDP, and to see the GDP to contract a little bit, it's just natural. You can't expect it to continuously
Right.
go up forever,
Yeah.
right? So for it to come down, is recession imminent? No one knows. A lot of economists, including our own, right here at LPL, we don't see 2022 being the recessionary environment that we're in. We're hoping that fuel prices and gas prices kind of like subside, because that's a big contributing factor to it. If all else being equal, the Fed is trying to make sure we have what we have. It's called a soft landing, right?
Mhm.
Where the consumers stay strong and they spend, and that they don't get spooked and keep their money in the bank and just save it.
Yeah, certainly the data is there for all signs pointing to stay the course, mental calmness, as we always talk about. And certainly you don't want to miss that. I think you may or may not have seen our short piece in the past of the best days and the worst days of the market. Well, we don't know when that is, right? So to pick the best days in the market, nobody can know, nobody can tell. So certainly stay the course, and Sean and I are always happy to have a chat with you all about this. Certainly, there's plenty going on this year and so many talking points that we can certainly go over. So feel free to reach out to us at any time. We'd love to have a chat with you about it again. So again, thank you all for your time. Certainly appreciate it and hope to see you all soon.
Thank you so much, everybody. And we'll hope to see you soon. Take care.